Hello everyone, I am Patrick, for the youngest who may not know me. 10th of March 1975 was the very day when I joined the reinsurance industry. Today, I am on the verge of retiring after 47 years working with patients. Tomorrow, what kind of future for this industry? Let me try a guess. From past memories to future guesstimates, overlooking today's assessment, this will be our story over 6 tutorials. Today we start with key figures. Insurance in 1975 was a privilege of so-called developed countries. USA, half of the world premium, ahead of Japan, few European markets, Australia and Canada. Africa, Middle East, India, LATAM, communist countries were not or hardly insured. 2021, the shift to east of our world appears clearly. China, second world ranking. India, number 10, was number 20 in 1975, behind Korea, South Korea, number 7. 2030, the shift to east will continue, along with the economic development of this area. The rest of the world entity, that is Africa, other Asian countries, Middle East, LATAM, will increase its market share according to increased population, insurance penetration, and economic weight. Insurance, reinsurance. In 2020, insurance and reinsurance worldwide premium were estimated respectively at $6,287 billion. Parallel to that, the world reinsurance premium was $320 billion. That is about 5% of worldwide insurance premium, life and non-life together. Reinsurance as a percentage of the global insurance premium has reduced gradually over the years as the number of small players with important reinsurance needs had strongly declined. Large groups have started to look at their reinsurance needs on a global basis, reducing year by year by hundreds of millions the reinsurance volume ceded. Prices have decreased regularly in view of overcapacity available. Life reinsurance premium was marginal. Today, this downward trend is over. Reinsurance premium is back to growth due to an increased risk-adverse attitude of large insurance companies who want to reduce the volatility of their results, impaired by loss frequency and squeezed margins on direct pricing. Large quota share are ceded even more when attractive commissions can be achieved, considering the premium appetite of some reinsurers. Strict solvency requirements. Fast-growing lines of business, agro, health, and their volatility, reserves needs. This leads as well to high proportional reinsurance cessions. New players, insurtechs, growing quickly, need reinsurance support to face the solvency ratio requirements. The uncertainties, volatility linked with this new venture, and see the high percentage of premium through quota shares. Increased insurance prices following losses on commercial and retail business impact the proportional reinsurance premium. Increase reinsurance prices. Overcapacity has gone. After a string of losses on cat properties, especially not allowing return adequate to cover the cost of capital. During too many succeeding years, many players have reduced or withdrawn capacity, leading to price increases. Better understanding of potential loss accumulations across lines of business and across the world, both on traditional and on emerging risk, lead to a demand increase for reinsurance cover. An increased penetration of reinsurance on the life side with financial deals and big volume at stake. The players, not these kinds of players, the insurers first, the insurers. 1975, insurance is a well-known activity in the Western type countries among the people and corporates. For individuals, this has mainly to do with motor third-party liability insurance, which is in many countries compulsory by law. Household, homeowners insurance coming after. For commercial industrial entities, the main risk is considered to be fire. Insurance is hardly known in most countries for political, cultural, economic and or social reasons. Today, insurance is spread worldwide with huge developments in Brazil, China and India, for instance. It is better understood and looked for by insurers, people and corporates, more and more risk adverse. Insurance covers many more types of risk which were not known and or not insured in the past. Despite this wider spread of geographical reach, larger range of products offered, better understanding from insurers of insurance purpose, today, insurance has a role which, expressed as a percentage of worldwide GDP, is decreasing. The insurers. 1975, stock companies, mutuals and cooperatives, family-owned companies offer their products, most of them, operating in only one market. A famous corporation called Lloyd's has its own way. Small companies, a huge quantity, many mutuals. Finland, a market with only 4.5 million inhabitants. I enjoyed a training course at Sampo in 1977, had more than 100 companies, most of them with a premium income below 1 million euro. Middle-sized companies, good number, regional, client-specific or line of business dedicated ones. They share an important part of the market. Big companies, quite a few, but not dominant in fragmented markets. Globals, pretty rare. AIG, Allianz Generali and Zurich, few US and UK companies. Note that Captive, created in the 50s in US more for tax avoidance purpose, are rare in Europe, but developing. For instance, Swedish captives incorporated in Luxembourg. Communist countries or tightly controlled states like India, few state-owned companies. Today, landscape, traditional companies have disappeared by hundreds. The concentration process did affect smaller players, medium-sized and bigger ones. The surviving smaller and or specialized companies have merged and or extended the range of their products and or their geographical basis to remain relevant. The remaining big companies have increased their market share in their core markets. They have eventually divested from others where they didn't reach the size targeted. Globals. Some companies have reached the size of a global player through M&A. In Europe, AXA, Ageas, Ergo, Mapfre, Talanx went up. Others down, like RSA. In Asia, Australian, Japanese, Korean, and Chinese giants spread their wings. New ones? Let me jump in your game, as said Jim Morrison, have appeared in two waves, with disrupting distribution approach. From the 80s onwards, bank insurance and direct insurers. Bank insurers, banks using their client base, selling over the counters, have invaded the insurance field and been particularly successful with life products, taking over more than 50% market share in France within 2 years. Their position has developed more slowly on non-life due to the nature of the business involved, infrastructure needed, claims handling, etc. Direct insurers, targeting mass products, motor, homeowners, using call centers, have entered markets with great success like UK, Israel. The success in one country did not replicate automatically in other ones, like Germany. Cultural differences remain an important factor. Tao has different ways. Another wave, InsurTech, the new generation. Daring entrepreneurs supported by daring investors, $1 billion funds in 2004, nearly $15 billion in 2021, have created platforms with technological tools, AI, database, analytics, selling mass products, motor to start with, shortcut in offering and underwriting at an attractive price. InsurTechs grow quickly their market share through their disruptive marketing approach and attractive prices at the cost of traditional players. This with the support of some reinsurers. InsurTechs consume a lot of cash. If their growth attracts initially additional capital at some stage, it does raise A rounds and DARPs. To be an InsurTech does not mean automatic success. The failure of 3BI, which was reported by 20 well-known reinsurers, but no brokers, is one example. More are bound to happen. Investors are less enthusiastic about funding and ever postpone return, and the dramatic downward trend of stock value of once promising companies is a noisy wake-up call. Some players, financially sound and well-established, have opted for cooperation with InsurTech companies using their platforms and paying fees and or investing in these. For InsurTechs, a cooperation with well-established players may be less risky than having their own pricing, modeling, cost of building up a book, and claims handling.